Hello, and welcome to today's Bitwise webinar, Crypto for Financial Advisors, an introduction to a new asset class. My name is Matt Hogan, and I'm the Global Head of Research here at Bitwise Asset Management, and I'll be your host for today's webinar. I'm pleased to be joined today by my good friend and colleague, Phil Glazer, who works with me on the research team and will be joining me for the Q&A portion of the webinar at the end. Bitwise is a specialist crypto asset manager and creator of the world's first crypto asset index fund, the Bitwise 10 Private Index Fund, which launched in November 2017. The Bitwise 10 is designed to give professional investors, family offices, multifamily offices, institutions, and financial advisors an easy way to get broad-based, diversified exposure to the rapidly evolving crypto market. The fund is available directly or through most major advisory platforms, including Schwab, Pensco, Kingdom Trust, and others. You know, one of the things we do at Bitwise is spend a lot of time talking to financial advisors like you. We know, both anecdotally and through surveys, that clients are asking questions about crypto. And our goal with this webinar is to help you answer them, to give you reasoned, data-driven analysis that separates truth from fiction. We want to outline the true risks and opportunities and leave you with concrete ideas you can put to work today. Before we begin, one little bit of housekeeping. We do want this webinar to be as interactive as possible. As such, you can ask questions of me or Phil using the Q&A toggle on your webinar viewing browser. Please don't wait to ask your questions. Ask them as they occur to you. We'll collate the questions and answer as many as we can at the end of the webinar. And if we don't get around to answering your question directly on the live webinar, we'll get back to you with a personalized answer by email within 24 hours. We want to be your trusted partner when it comes to crypto, and that means Phil and I and the rest of the Bitwise team are always on call and available to answer your questions. And with that, let's get started. You know, I joined Bitwise in February of this year after more than a decade working in the ETF industry. And in the ETF industry, there are some truths that most people can agree on, that low fees are better than high fees, that ETFs are tax efficient, that many active funds trail the market. And even when people don't agree on something, the discussion is polite, rational, and data-driven. But one thing I noticed when I joined crypto is it's like living in the world of hyperbole. You have folks like Warren Buffett saying that Bitcoin is like rat poison squared. Not just rat poison, but rat poison squared. On the flip side, you have folks like Jeffrey Sprecher, CEO of ICE, the parent company of NYSE, saying that Bitcoin has the potential to become the first worldwide currency. You have folks like Jack Bogle, one of my heroes, telling people to avoid Bitcoin like the plague. And folks like the International Monetary Fund, saying that crypto assets are so important that they may one day reduce the standing of central banks. You have Jamie Dimon calling Bitcoin a fraud, saying it's worse than tulip bulbs. And Wences Cesares, one of the most thoughtful proponents of crypto, saying that one Bitcoin will be worth $1 million. Not that it might, not that it may, not that it could be worth $1 million, but that it will. And sometimes, against all this hyperbole and all this back and forth, it's hard to know where things really stand. So let's talk about some of the data-driven facts that we know are true in crypto. We know, for starters, that all crypto assets in the world today are worth about $210 billion. Now, $210 billion is a lot of money, but it's not that much. It's about two-thirds the market cap of Visa, about half the size of Facebook, about a quarter the size of Amazon. So it's real and substantial, but anyone who says that crypto is in a bubble is getting ahead of themselves. Tech stocks were worth $30 trillion when they peaked in 2000, and that was a bubble. At $200 billion, for something that people say could change huge swaths of the economy, crypto is still very early, and you as a financial advisor are still very early if you're listening to us today. What else do we know? We know that there are about 1 million Bitcoin and Ethereum transactions per day. Again, that number is real and substantial, but it's not massive. Think of it as a proof of concept. Billions of dollars of crypto changes hands every day, and we know the system works, but it's not yet widespread, and it hasn't scaled. By comparison, Visa does 150 million transactions per day. And we know this. that despite the much ballyhooed pullback, crypto prices are up 741% since January 2017. In fact, if you're a student of crypto, you know that the pullback we've seen in crypto prices in 2018 is something we've seen many times before. In fact, we saw bigger pullbacks in 2012, again in 2013, and in the so-called crypto winter of 2014 and 2015, when Bitcoin prices fell 83% from $1,100 to about $200. In each instance, the pullback set the stage for a strong surge upwards. And there's some reason to believe that things are setting up for that to happen again. This is a list of major firms that have announced either new crypto services or significant investments into the crypto space since I joined Bitwise in February. And these aren't small names. In the past month alone, we've seen Fidelity launch a new digital wealth program, Yale's endowment make its first investment in crypto, IBM roll out a global payment solution using crypto assets, TD Ameritrade invest in a crypto exchange, and ICE, the parent company of the New York Stock Exchange, announced a date for the launch of new one-day physically settled Bitcoin futures, all in the past month. I raise all these points to make the point that crypto is not going away. You can't just dismiss it as rat poison or tulip bulbs anymore. Big firms are making big bets on the space, and the pace is accelerating. At this point, you owe your clients to do what you're doing today, to dig deep and really try to understand it. Our survey suggests 50% to 80% of financial advisors have received questions from clients on crypto, and that pace is going to accelerate as it enters the mainstream, with folks like Fidelity, TD, and others coming on board. The hyperbole doesn't help. Next time you see a headline saying either this changes anything or it's rat poison and tulip bulbs, just turn the page. What we need is balanced research and analysis. You may want to invest in it. I don't think Harvard, Yale, and Stanford are making allocations for fun. We'll cover some data suggesting why we think crypto has a role to play in many investors' portfolios in the second half of this presentation. And finally, you definitely need to understand the risks, because there are big risks here. Risks in how you get exposure, risks in how you trade, and most of all, behavioral risks that come with understanding the unique nature of this emerging asset class. So that's what we're going to talk about today. We're going to cover crypto soup to nuts, from Crypto 101, what crypto assets are and why they are important, to why crypto assets have value, the difference between crypto and blockchain, and the role crypto assets can play in a portfolio. And as mentioned, we'll save plenty of time at the end to answer your questions. So let's start here. What crypto assets are and why they are important. Crypto's often been called the Internet of Money, and it's true that one of the core applications of crypto is that it allows us to send value over the internet. So maybe it's not surprising that one of the best ways to understand what crypto assets are is to think about the simple task of paying someone. In the old days, when we used cash, paying someone was simple. Cash is a bearer instrument, meaning that if you hold cash in your hand, you own it. And if I have $1 million and want to give it to you, I can simply hand you that $1 million, and that would be it. Now, that simple cash transaction has a lot going for it. It's unambiguous. Everyone knows that I have $1 million at the start and that you have $1 million at the end. It also settles instantly. The moment you get that $1 million, you could spend it unencumbered. And it's free. There's no charge for handing you cash. But cash isn't very safe and it's messy, so we now use a different, more modern solution to move money electronically. It's called a bank. Now, electronic cash is a little trickier than cash. Electronic money is just a string of digits, ones and zeros, and if I'm sending you money electronically, you need some way to trust that I have the money and that I really sent it to you, and that role is filled by a bank. If I have an account at my bank and I tell it to send $1 million to you, the bank will debit my account. The way it gets into your account is that my bank will have a shared ledger with your bank, essentially a place where they keep track of which bank owes the other bank what, and they'll subtract money from one side and add it to the other, and then your bank will add money to your account and be done with it. At each stage, the banks will need verification that the money is in each account and moving properly, that it's truly owned by the person who says they own it, and that you haven't, say, written two $1 million checks, but only have $1 million in your account. And to do these various services, they'll charge a fee, and typically it takes them a few days to do the work to allow the transactions to settle. Now, sometimes the transaction is a little more complicated than that. If I have a bank account in California and I'm trying to send money to someone in South Africa, my bank might connect with a money center bank in New York, and that money center bank may then connect with a money center bank in Frankfurt, where my dollars will get turned into euros, and that money center bank in Frankfurt might connect to one in Johannesburg, where the money will be turned into rand, and that money center bank in Johannesburg may reach out to a local bank in South Africa, and in each step along the way, there will be little fees and settlement delays, which in aggregate are a big deal. A big deal like this. Workers in the U.S. who send money home pay an average fee of 8% and have to wait 3 days for their money to settle. To make that a little more real, 8% is the same as 1/12, meaning that people who work here and send money home spend 1 month a year working for Western Union and another 11 months working for their family. Wouldn't it be better if you could just send the money directly to your family, peer-to-peer, with no rent-seeking middleman and no settlement delays? Wouldn't it be better if you could just email cash the same way the process worked when I hand you $1 million in $100 bills? And that's essentially what crypto allows. Crypto allows for digital, peer-to-peer transactions without a central authority, meaning you have nearly immediate settlement, minimal fees, and you eliminate the rent-seeking middleman. It is, as the saying goes, the internet of money. Now, why, you're probably asking, was this not possible before? I can FaceTime from my watch with someone in Antarctica. Why can't I send $1,000 over the internet without paying huge fees or waiting days for settlement? And the reason for that essentially boils down to what's called the double spend problem. The problem with digital cash, or the problem with digital bearer instruments, is that it's just a string of letters and numbers. Now, counterfeiting paper currency is hard, but copying and pasting a string of letters and numbers on a computer is easy. So how can you be sure, without a trusted central party standing in the middle and keeping watch, that someone isn't, say, sending the same money to multiple people? And the answer to that is what's called the consensus protocol, or what many people refer to as crypto mining. And if you pay attention to any portion of this webinar, I'd suggest you pay attention to this, because this is the heart of the matter. Mining, the process you hear about people, quote unquote, wasting energy, is how blockchains function, how they process who is sending value to whom, and how they make sure that no one is sending the same value twice. And it works like this. Everyone participating in a network like Bitcoin has the ability to send out proposed transactions. If I want to send $1 million to Alice, I'll send a message into the network saying, I want to send $1 million of Bitcoin to Alice. Now, all the computers that are keeping track of the Bitcoin ledger, the spreadsheet essentially of who owns what in the Bitcoin network, they will take a bunch of these proposed transactions and combine them into what's called a block. A block is just a group of thousands of transactions put together. Now, importantly, they can only combine valid transactions. If I tried to send the same $1 million of Bitcoin to both Alice and Bob, a miner would have to choose which of those two transactions to take. They then combine all these valid transactions into a block, and they race with other miners to solve a really hard math problem. The problem is so hard that it actually doesn't matter how smart you are. It just matters how much computing power you throw at it. It's effectively a random race to see who solves it first. Now, the first miner that solves the problem broadcasts that solution to the network along with their block of all the validated transactions. The other miners out there will check to see if the proposed solution is correct and the transactions are valid. And if they are, everyone will update their copy of the blockchain, their copy of the ledger of who owns what, to the new official state. This new copy will show that I used to have $1 million, but I have sent it to Alice. The miner that solves the puzzle first is rewarded with some amount of the crypto asset as compensation for keeping the network up to date, and everyone moves on to the next puzzle. Now, importantly, the next math problem is built on the information in this past block. So you can't solve the next puzzle if you change any of the historical data. Now, this process of mining does a lot of things. For starters, it solves the double spend problem because miners can't make a block with invalid transactions. This is actually a huge breakthrough. So what you're seeing on the screen here is a picture of a crypto kitty, which is sort of the first digital collectible. This was a craze that kicked off at the end of the last year, and this particular kitty sold for something like $120,000. Now, I know what you're thinking. You're thinking, are these people crazy paying $120,000 for a virtual cat? But that's actually not a particularly interesting question because, of course, they're crazy. Paying $120,000 for a virtual cat is insane. A better question is why, 30 years into the personal computing revolution, when we all have smartphones in our pocket, is this the first time that you've heard of a digital collectible? People collect everything. They collect stamps, they collect art, they collect Beanie Babies, they collect $2 bills, they collect coins. Why have you never heard of a digital collectible? And the reason was because until crypto, there was no way to be sure that something digital was scarce. People only collect things that are scarce. And because crypto solved this double spend problem, it broke the mold, and now digital collectibles are a major emerging theme. The company that created CryptoKitties raised a significant round from some major VC companies, and we expect digital collectibles to be a big deal. The other thing that this process of mining does is that it makes your database incredibly secure. Because each subsequent block contains information about all the previous blocks, you can't go back and falsify records because it will invalidate everything that follows. It literally breaks the chain. That's why Bitcoin, despite storing $120 billion in bearer instruments, has never been hacked. It is a uniquely secure database. But most importantly, because it cuts out the need for this rent-seeking middleman who exists just to validate transactions and determine truth, because it replaces that human action with simple math. It makes transferring value electronically better, cheaper, and faster, and not just by a little. So this is an example from Ripple, the company, showing how using crypto assets can cut the cost of international payments by 60% and reduce settlement from 3 days to minutes. And it's not just new crypto-focused startups like Ripple that are suggesting this. If you go to IBM's homepage, you can find a new product they launched 2 months ago called WorldWire that uses the Stellar Lumens public blockchain to affect international payments with the tagline, settle international transactions in seconds and not days. This is a multi-trillion-dollar problem and an opportunity to reduce costs by 60% and dramatically reduce settlement times. And it's happening now. So it turns out, and this is why people get so excited about crypto, that a huge number of our biggest companies in today's economy, not just in the financial industry, they essentially act as trusted intermediaries to help process transactions. And so the ability to replace that trusted intermediary with something that is better, faster, cheaper, automated, means we can rethink huge swaths of our economy, from Wells Fargo to Visa to PayPal, and even to social networks like Facebook. Even I'll borrow a little hyperbole here, it does become really significant. With that sort of groundwork, let's turn the page to 201, why crypto assets have value, and why we think they'll continue to have value. We don't have time to talk about every possible valuation scenario here, but I do want to bring up two dominant ones that I think are easy for people to get their heads around. The first one is this, made popular by the Nathaniel Popper book from the New York Times, which is that crypto is a non-sovereign store of value, a new form of digital gold. And this is often the easiest valuation approach for people to get their head around. And it's also probably the most mature use case for crypto today. Crypto assets like Bitcoin and other crypto assets are a way for individuals to store significant amounts of value outside of government-backed fiat currencies, digital gold. And assets like Bitcoin have a lot to recommend themselves as store of values. They are scarce, fungible, divisible, non-decaying. They can be transported across borders very easily. But I know what you're thinking. You're probably looking at charts like this and saying, Bitcoin is too volatile to be a store of value. I hear this argument all the time. Look at this chart. It's up, it's down, it's sideways. Except that's not a chart of Bitcoin's price. That's a chart of the price of an ounce of gold after the U.S. went off the gold standard in 1971, when gold was, for the first time ever, untethered from government support and set out as a non-sovereign store of value. People forget this. But when the U.S. went off the gold standard, gold went through a period of wild volatility marked by massive ups and massive downs. It was up 73% in one year and down 24% the next. It was up 121% in one year and down 4% a few years later. And it makes sense. If you step back for a minute and think about how a new store of value would emerge into the world, you realize it'd be asking too much for it to emerge fully formed. You can't imagine a world where Bitcoin didn't exist one day and the next day it popped into existence with a steady state value of, say, $100,000 per coin. The first day Bitcoin existed, it was hugely fragile. No one knew about it. No one believed in it. No one knew if it would succeed. For all we know, the technology might have been flawed. What you would expect from an emerging non-sovereign store of value is exactly what we saw in gold. First, a rapidly appreciating price as people come to believe in the asset, with the pace of that appreciation tailing off over time. And secondly, volatility that starts enormously high as the asset has huge amounts of risk and gradually diminishes over time as the asset is established. And that's exactly what we've seen in Bitcoin. Massive early price appreciation, which has tailed off a little bit, and massive initial volatility that has come down dramatically in recent years. In 2014, it was common for Bitcoin's daily volatility to exceed 10%. Today, it's around 2 to 3%. In other words, Bitcoin is right on track. And as the millennial generation ages and Bitcoin becomes more and more established, its place as a non-sovereign store of value seems more and more secure by the day. I would add that this is a big deal because non-sovereign stores of value are a massive market. There's about $7 trillion of gold out there in the world, and Bitcoin is currently storing just 1.7% of that value. If Bitcoin were to match gold as a store of value, each Bitcoin would be worth about $380,000. On the other end of the spectrum, there's about $32 trillion in offshore wealth socked away in various tax havens. If Bitcoin or another less established asset like one of the privacy coins were to capture a significant portion of that market, you'd be talking about truly significant values. And even if crypto, Bitcoin, or the privacy coins are only fractionally successful in tapping into this market, the potential is really significant. It is, of course, true that there's no guarantee it will be Bitcoin or only Bitcoin that succeeds as a decentralized store of value. Other crypto assets, including some of the ones listed here, could compete for that role. Of particular interest, and we can talk about these in the Q&A if you want, are the privacy coins like Zcash, Monero, and Dash, which may be particularly appealing for store of value targeting the offshore wealth market. But the overall point here is that this is a massive use case. Crypto is already on track to fulfill it, and just this use case alone could potentially justify significant appreciation if it continues to be established. But of course, store of value is not the only or even the largest use case for crypto. When people say crypto could change everything, they mean something much bigger than replacing gold as a place to stash wealth. They mean, among other things, fundamentally disrupting much of the financial services market, which is an $8 trillion market today and growing very rapidly. Now, the reason that crypto threatens to disrupt much of the financial services market is because at its core, most of what financial services do is act as trusted intermediaries to facilitate transactions. They're large, rent-seeking intermediaries charging fees for trust, and they don't honestly always do a great job of it. It seems absurd to me in today's day and age that it takes 2 days for stocks to settle. It seems absurd to me in today's day and age that the fastest way to get money to some places overseas is to jump on a plane with a briefcase of cash and literally fly around the world and deliver it in person. Already, if you look at this slide, which shows all the things that JP Morgan purports to do, in the past 12 months, we've seen crypto eating away at various pieces of this value chain. More money has been raised, for instance, in ICOs than in early stage venture capital, tapping into the capital raising portion of the banking ecosystem. Just to take one example and showcase exactly how this works, narrow down to that Treasury Services tab in the middle of the slide, and specifically onto the word escrow. Now, I'm sure you've all worked with an escrow agent before. I'll use my own example. In a previous life, I acquired the URL www.etf.com from a domain squatter. And to enact this transaction, we had a lawyer who sat in the middle of our deal. My company sent money to the lawyer. The squatter sent the URL to the lawyer. And when both conditions were satisfied, the lawyer sent our money to the squatter and transferred the domain to us. And for this simple service, they charged us a couple $1,000s. This is a fairly common banking transaction. Crypto renders this pointless. Because crypto is software-based, it makes money programmable. You can set up a program, a smart contract, say, in the Ethereum blockchain to act as a virtual escrow agent. In this case, the squatter would upload the URL to the smart contract. I would upload the requisite value of Ethereum, and the contract would automatically cross the trade once those two transactions were met. Because it's not a person, it doesn't charge a fee, it doesn't make mistakes, it doesn't renege on deals. It's just a better, faster, cheaper, automated way. And you're able to do this because crypto makes money software-based and programmable. And this is probably one of the easiest ways to think about crypto. It's a new protocol that allows us to send value over the internet. And we've seen these new protocols emerge multiple times. SMTP was a new protocol that let you send email over the internet. VoIP was a new protocol that let you send voice over the internet. Blockchains and crypto are just a new protocol that lets you send value over the internet. And it turns out that can be pretty important. As Christine Lagarde said, the head of the International Monetary Fund, it's a fundamental breakthrough. And while there are some excess and some hype in the space, just as there was living through the dot-com bubble, some of the technologies that emerge from the crypto asset revolution are going to fundamentally transform our lives, just the way some of the technologies that emerged from the dot-com era fundamentally transformed our lives. All right, so that's crypto assets, what they are, how they work, and why they have value. Before we get to the Q&A, let's turn to the investment case. Now, one of the things we hear over and over when we talk to people about crypto is this quote, that I love blockchain, but I'm not sure about crypto assets. And I think it's important to recognize what that means. There are today both private and public blockchains. Bitcoin, for example, is a public blockchain. Individual companies, on the other hand, or consortium of companies, can host private blockchains. They function more or less the same way. They're distributed databases held at multiple servers that enshrine transactions in a way that can't be changed. But the key difference is that public blockchains are supported by crypto assets and that they exist without any centralized authority that control access to that network, or who can determine who can transact on that network, who can determine to shut down that network. Now, this is a pattern we've seen in technology in the past, and there's an easy way to think about this difference between private blockchains and public blockchains. Back in the early days of the internet, most of the internet actually existed in private walled gardens. They were called corporate wikis or internal websites. And people actually thought that public internet sites were a crazy idea. When Amazon came out, the idea of entering your credit card number into an online website was insane. But today we've seen most of the value develop on public internet sites that can be accessed by anyone. And while corporate wikis still exist and serve an important function inside individual companies, they're incremental improvements and they become less important over time. Now, there are plenty of good applications of private blockchains out there, and in the right setting, they can be incrementally more efficient and allow incrementally more transparency into transactions than other database infrastructures. But the important thing to realize, they're not revolutionary. They're incremental positives. The revolutionary bit revolves around removing the need for a centralized source of truth and replacing that trusted rent-seeking intermediary with math. Now, there are a number of ETFs out there that try to capture the opportunity in public and private blockchains through the equity markets, and these can be interesting investments. There's some data suggesting that these tech-forward companies have higher risk-adjusted returns than the broad-based stock market. But I do want to point out that the return characteristics of these investments are very different from the return characteristics of actual crypto assets. So if you look at the two snapshots here, the one on the top and the bottom compare the returns of the two largest blockchain ETFs, the green and blue lines, against the price of Bitcoin in red. And you can see that there are periods where Bitcoin outperforms, such as the last 30 days, and periods where the blockchain equities outperform, such as the last 180 days. But importantly, the two patterns of returns are very distinct. In fact, blockchain equity ETFs tend to have a correlation to the S&P 500 that hovers around 0.9, meaning they move more or less in lockstep with broad-based equities, which is not surprising since they are equities. By comparison, crypto's correlation to the S&P 500 tends to hover around zero. So these are very different things. It's akin to the difference between private and public blockchains. One is an incremental advance, and one is something completely different. The other sentiment that we hear a lot from investors is that they think they have exposure to crypto because they own Bitcoin. And while Bitcoin is a uniquely attractive and interesting asset, it's important to recognize that it is not the entirety of the crypto market. What this slide shows is how the crypto market has evolved over the last few years. That sort of pinkish yellow color is Bitcoin's share of the total market cap of the crypto asset space over time. And you can see that it's come down from being 90 to 95% of the market to being about half the market today. There are actually over 2,000 crypto assets in existence today, and while the bulk of the market capitalization is focused in the top 10, there is significant dispersion between the Bitcoin allocation and the rest of that marketplace. Now, a lot of people ask me, why do we need all these different crypto assets, and won't the market coalesce around one crypto asset that will cover everything? And the answer to that is maybe. But the right way to think about it is that this is a new software technology, a new protocol for sending value over the internet. And there's a bit of a protocol war going on right now about the best way to build a blockchain to meet the needs of individual users. And different crypto assets are maximizing and focusing on different parts of this protocol war and optimizing for different characteristics. An example at the top of this chain, Bitcoin is a hugely decentralized crypto asset. There are many, many nodes around the world. There's no central party that owns a large share of the crypto asset. The advantage of that is that it is a great non-sovereign store of value. There's no one who can shut it down, disrupt it, alter it. The flip side is it's very slow. There are other crypto assets that have traded off some element of decentralization for speed. EOS is an example where all crypto mining is done by just 21 nodes. And the result is that EOS's network is much faster than Bitcoin's network. Now, it remains to be seen which is better. Do you want a truly decentralized blockchain that's great for moving value slowly? Is that the dominant use case? Or do you want a more centralized blockchain that can move value very quickly but is more susceptible to centralized control? Another example is, do you want something like Bitcoin where you can only do a few things with the software, like send it, receive it, or destroy it? Or do you want something like Ethereum where it's a Turing-complete software and you can have the kind of programmable money examples that I was using before? You might think it's always better to be able to do more, but software cybersecurity would suggest having limited programming languages reduces the attack vector, makes the blockchain less susceptible to hacks. So there are 7 of these different places that different crypto assets are optimizing for, and it remains to be seen which will be the most valuable. A good way to think of it is to look back at other protocol wars that have taken place over time. There was, for instance, Betamax and VHS competing in the cassette space. There was Blu-ray and HD DVD. There was MySpace and Friendster and Facebook. In each case, those were different sort of protocols, different ways of interacting with an environment, and each one optimized for a different characteristic. Sometimes the first breakthrough, the first to move into that market became the most successful. At other times, new technology and new approaches supplanted things. Even in the early days of internet, there were about 85 different original internet protocols before the market settled on TCP/IP, and that became the dominant way we approach the market. So our point of view is that it's difficult to know exactly how crypto will transpire. It's clear to us that crypto will be significant and reshape the world in important ways. But the best approach, from at least our point of view, is to have broad-based exposure because you don't know exactly which of these protocols is going to win. Just a few more slides before we open it up for Q&A. So do enter your questions in the Q&A toggle on your screen. But I did want to talk briefly about how we're hearing from investors, how they're thinking about adding crypto to a diversified portfolio. So crypto is a unique asset in that it combines a number of features that haven't historically been combined into a single exposure. As this slide shows, and as all of you know, crypto has combined strong historical returns with low correlations to other assets. So on a historical basis, looking backwards, crypto has been almost had zero correlations to stocks, bonds, gold, commodity, volatility futures, liquid alternatives, virtually anything you looked at. Now, we do get questions about whether this low correlation will persist, but when you think about the fundamental drivers of crypto, they're very different from the fundamental drivers of stocks and bonds. Stocks and bonds are driven by economic growth and corporate profit and interest rates. Crypto is driven by network effects and technological developments and regulatory developments. So these are very different assets, so there's reason to believe the low correlations may persist over time. Now, typically, when you combine high potential returns with low correlations to other assets, you're talking about early stage venture capital. And what you give up in combining those two things is liquidity. Crypto is unique in that you get low correlations and high potential returns, but you also get daily liquidity, or in the case of our fund, weekly liquidity. And that allows you to use crypto in a way you haven't used other alternative assets in the past. That allows you to make it a fundamental part of a balanced portfolio and to rebalance that portfolio if your position in crypto gets out of whack. And when you do that, you get really interesting results. So this is a slide based on a white paper that's available on our website. It looked at the impact of a 1, 5, or 10% allocation to Bitcoin over literally the worst period we could study that impact, from the start of 2014 to the end of Q1 in 2018. That was the start of the Bitcoin winter, and it ended at the depth of the 2018 pullback. And what you can see from this slide is that adding a 1% allocation to Bitcoin, assuming you rebalanced, increased the total return by about 5%, while keeping the volatility more or less flat, boosting the Sharpe ratio by 25%, and lowering your max drawdown. Even a 5% allocation to Bitcoin, which is at the far outside of what we hear from our clients, almost doubled your return. It did boost your volatility some, but it doubled the Sharpe ratio, and the maximum drawdown came in substantially because crypto has that unique aspect of being non-correlated to other parts of the market. Our point here is that this is a potentially generationally important technological breakthrough, that it's still relatively early in its development, and that crypto has these unique characteristics of relatively low correlations to other assets, high potential returns, and liquidity, which makes it an interesting allocation at a small level in a well-diversified portfolio. Just to round things out, Bitwise did create the world's first cryptocurrency index fund. It's the Bitwise 10 Private Index Fund. It tracks the 10 largest crypto assets by 5-year diluted market cap. That captures about 80% of the market and most of the investable portion of the market. It screens out for risks like trade volume, compliance, concentration, security risks. It reconstitutes monthly, and all crypto assets are held in cold storage. This is an easy way for accredited investors to get broad-based exposure to the crypto market. Over time, the exposure has done well. We wouldn't dwell on its outperformance against Bitcoin, which you see in this slide, but rather make a broader point. The investors that we talk to know or think or are curious about whether crypto is going to be significantly important in the future. And they want to be sure that if that turns out to be true, that they capture that value creation over time. And one way to be sure that you capture that value creation is to take a broad-based approach focused on the top crypto assets and making sure that that index-based exposure stays on top. So we have covered a huge amount in this presentation. I know that it's been a bit of a fire hose, but we would like to get to your questions, and so I'm going to bring Phil in here. Phil, are you there?
Yeah, I'm here. Thanks for welcoming me in, Matt.
Oh, thank you for being here. So our first question is actually about something we've heard about recently with ICE and the New York Stock Exchange and their BACT program. Can you tell me what is BACT and what is the Intercontinental Exchange working on?
Yeah, it's a good question. The announcement around BACT was made a few months ago. This would be a partnership that the Intercontinental Exchange had been working on with a few other partners that at the time, not many details were provided on. There were suspicions that they would be launching their own exchange product. And as of a couple days ago, we've learned that starting in mid-December, BACT will clear single-day physically settled Bitcoin futures, which is exciting. For now, the existing futures options are all cash settled and monthly, run by the CBOE and the CME. And BACT will be another legitimate player coming into the space. Again, when it was announced, there were little details on who'd be joining the company. And a couple weeks ago, they had hired Adam White, who was one of the first early employees from Coinbase, to join as their COO.
Well, let's another question on this sort of big companies moving into the space. What do you make of the announcement from Fidelity, and what exactly are they planning to do?
Yeah, that's another good one. A couple weeks ago, Fidelity announced their digital assets initiative. To start, they're going to focus on addressing the biggest pain points that institutional investors have raised, which first is custody. One of the shortcomings in the crypto asset space right now is that, as you mentioned, crypto assets are digital bearer assets. And as such, the custody and security of those assets is very important and also difficult to do for people who don't have the depth of technical expertise. So it sounds like from the announcement that Fidelity will be providing this custody service. A second pain point that institutions have highlighted is the problem of executing orders. In the existing financial system, there are many banks that provide services like prime brokerage, and there are very well-developed order routing systems. But in the cryptocurrency market, the exchange ecosystem is fairly fractured. There are exchanges that operate in the U.S. and Asia, and for now, the services don't exist, but Fidelity will be stepping in to provide that.
All right, one big picture question. There's been a lot of good news recently. Fidelity, BACT, Yale, Harvard coming in. What could derail crypto in the remainder of the year? Are there any worries about Tether, or what keeps you up at night?
Tether has been fascinating to watch develop. For some context on Tether, Tether is a fiat collateralized stablecoin run by the same group that runs Bitfinex, which is an exchange. And a fiat collateralized stablecoin is an operation that takes in US dollar deposits and issues units of cryptocurrency, in this case Tether, which is USDT. And Tether has been concerning because, one, it's very large. As of a few weeks ago, there were $2.8 billion worth of Tether units outstanding. And second, because there had been concerns about whether Tether is potentially operating a fractional reserve. So they have this ability to issue units. It's possible that for every unit they issue, perhaps they only have 80 cents. in the last month, Tether went through the situation where the peg, normally Tether had been trading at $1 per unit on exchanges, had dropped to as low as 95 cents on the dollar on fears that there was a potential bank run that was going to happen on Tether. And over the last 3 weeks, Tether has gone from $2.8 billion outstanding in units to about $2 billion. So they've been able to successfully liquidate $800 million worth of units. The price of Tether has recovered to 99 cents on the dollar, which is a positive development. And as a backdrop to this, exchanges in the ecosystem have responded. So they've moved to launch other stablecoin offerings from providers that people have greater confidence in, like Gemini and Circle. So if you'd asked me a month ago what keeps me up at night, it would be Tether at any moment could be something that causes significant panic in the ecosystem. At least over the last few weeks, it looks like that concern is slightly diminished. It's worth noting that there are still $2 billion remaining in Tether units outstanding. So it's possible that could be a negative development that plays out over the next few months. But for now, it looks like that's relatively contained. So outside of potential Tether concerns and stablecoin concerns, there is still some regulatory uncertainty with these utility tokens, so tokens outside of Bitcoin that maybe aren't used as currencies, but are instead for powering something like the Ethereum virtual machine. It's worth noting that Director of Corporate Finance of the SEC, William Hinman, has stated his opinion that Ethereum is not a security. The SEC and CFTC don't consider Bitcoin to be security, but it's possible that some of these other smaller projects would be considered securities. So those, for me, are the outstanding concerns.
Great. I'll take this next question. What was available at Charles Schwab from Bitwise? Bitwise 10 private index fund is available on the Schwab alternative investments platform. If you have any questions about that, feel free to email us investors@bitwiseinvestments.com, and we will get right back to you. Last question, and then we'll wrap up for the day. When will a crypto ETF be launched? And should I just wait until that product is launched to buy in? I'll let you take a swing at it, Phil, and then I'll provide my own thoughts.
Sure. Yeah, definitely happy to hear your additional thoughts on this. In terms of when a crypto ETF will be approved by the SEC is difficult to say. There have been numerous filers with different, each filer has taken multiple swings. And for now, one of the remaining concerns is that it's possible, the SEC thinks that it may be possible that the price of Bitcoin could be manipulated. So while these filers have determined how they would like to price their ETF for Bitcoin specifically, it's possible that the sources of information they pull from, for example, Gemini, just a single exchange, could be impacted by malactors, people who have negative views of the market. I'll turn it over to you for additional thoughts on that.
No, I think that's right. I think the questions the SEC has been asking have been spot on. I think they've been thoughtful questions about the market. I think, the ETF issuers and potential ETF issuers are going to try to continue to answer those questions. And I'm bullish on a crypto ETF launching in 2019. As far as timing, there's no way to tell. It depends on each person's confidence and willingness to invest in private vehicles. There are good private vehicles out there from Bitwise and from others that allow you to invest now. Other people will wait till the ETFs launch. It is perhaps worth noting that in the initial sort of excitement around crypto ETFs back when the Winklevoss brothers filed their first ETF, there was a substantial run-up before the announcement that it was ultimately rejected as anticipation built. And I wouldn't be surprised if there was some anticipation that built up as crypto ETFs get closer to launch. But of course, there's no way to tell. These were great questions. I appreciate everyone taking an hour out of their day to learn about crypto. I would say that Phil and I are always available to answer any questions you or your clients might have about crypto. We love writing memos. We love hearing from customers and potential customers. Feel free to reach in. You can reach me, Matt at Bitwise Investments, or Phil at Bitwise Investments, with any questions you might have. We do want to be your trusted source for crypto information and analysis. So thanks again for joining. I hope that you enjoyed today's presentation. Have a great rest of your week, and we'll talk to you again soon.